Futurists think about two things differently: time and the management of opportunity and risk. Every time we plan for the future, start a new project, set a goal, we're making a bet. A futurist doesn't have to win every bet, but instead looks to win across all bets. Rather than just setting the stakes and waiting to see which horse wins and which one falls in the hurdles, a futurist actively manages their portfolio. 1. Set up your initial allocation and then focus on reallocation to the winners. How do you know when and where to reallocate? Look at both the short and long term simultaneously and gather evidence to fine-tune your immediate actions. Enough with theory. Let's jump into how this applies to winning the money game. A portfolio has goals and manages opportunities and risks. Some goals that you might have would include ensuring you have enough money to live on in retirement, maybe also giving yourself some passive income to create the freedom and control so that you can live the life you want to live. So opportunities in a money portfolio are pretty much all around growth, but there are several risks. Risks that have a very high certainty include taxation, inflation, and penalties and fees on your account. You might also see an interest rate drop or even a market crash that obliterates the contributions that you've made so far. Besides a market crash, what else could reduce the contributions that you made to your investments? This could be an emergency, a job loss, a health issue, death, disability, or even getting a late start. We've all heard about deferring tax until retirement, but this is on our risks. Why? This recommendation was born in the 1980s. In the 80s, a small reduction in income could easily change your tax bracket. There were a bazillion tax brackets, and the differences between the thresholds were small. Maybe only a couple thousand in the difference. That's not true today. Unless you're right on the borderline between tax brackets, you probably need a big reduction in your standard of living to be able to move between tax brackets upon retirement. Not only that, but in the last 40 years, or the length of a traditional career, the U.S. federal income tax brackets have changed 11 times. Not to mention what happened at the state level. Do we care that much about tax? Well, just like interest compounds, so does tax. If we take a hypothetical example of $1 invested doubling every year, the difference between having income tax applied to that account and not having income tax is more than $1 million. Let's set up a portfolio to manage these risks so we can achieve our goals and maybe some more. Just a quick disclaimer, I am not a financial advisor. This video is for education purposes only. If you need financial advice, talk to a licensed professional about your own personal circumstances. Firstly, we're diversifying our portfolio to make sure that we have some safe investments and some high growth or high risk investments. Most people know this. The next step, though, is spreading our tax obligations. We want some things where tax is deferred to retirement because, of course, we don't know if we'll end up in a friendlier tax bracket given how often it changes. We also want some investments where the tax is already paid on the account so that we're creating a basis for tax-free growth. This is where we get that extra $1 million in the hypothetical example. We also want to consider investments that are reducing our tax burden in the current year through tax deductions. These investments look like your pension or 401k in the tax deferred high growth box. You should always get the maximum employer match possible. This is 100% growth immediately. There is nothing else that you will do that is as good as that. The only time that there's an exception to putting these kind of accounts in the high growth box is if you're only a couple years out from retirement. While the income from this box is protected from bankruptcy, it may not be protected from death, disability, and if it's a defined contribution, then it's probably not protected from market fluctuations. You should definitely check with your fund manager to figure out what the T's and C's on your account are. Skipping over to tax paid, let's start by looking at the tax-free growth box. That's the bottom right-hand box. Here we have our Roth 401ks, our 529 accounts, our HSAs, our tax-free municipal bonds or tax-deferred annuities, and our cash value life insurance like whole life or universal life. These are tax advantage accounts, meaning that you're not taxed on the growth in the account. For example, a Roth 401k, when taken after 59.5 at retirement, is taxed in the 0% income tax bracket. 529 accounts have the same tax-free growth if you use the money to pay for your kids' or grandkids' college education, and HSAs have the same tax-free growth if you use them to pay for health-related expenses. All of these have contribution limitations. Cash value life insurance has tax-free growth, is protected from creditors, has no income limitations unlike a Roth, has a guaranteed return on risk, is self-completing in the event of disability or death, meaning the insurance company pays your premiums. It keeps up with inflation since it's tied to the market, but it also has a guaranteed cash value, meaning that you can't lose what you already have. It allows you to take a free loan out on the policy, and the dividends on the policy can either be used as a supplemental income in retirement or to pay the premiums on the account. On top of all of that, it also has a death benefit. Moving on to stocks, crypto, DAOs, NFTs, or angel investments. These are the high-risk, high-growth investments that give you some potential for passive income. Once you've completed the process with the other boxes, spend some time on this one, looking to spend at least 10% of the money that you'd allocate to this box on the genuinely high-risk investments. This will give you that potential for outsized growth on your investments. This box is mostly taxed as capital gains. To keep more of your current income for investments, don't leave out tax-deductible investments, which are usually related to debt or business expenses. Get a good stable rate on your mortgage and use the interest on the mortgage payments as a tax deduction. Then you can use the difference in the amount that you would have paid for your mortgage payments to invest in a higher interest rate returning product. This will give you two different types of return. One type of return is the savings on your tax, and the other one is the difference between the interest rate on your mortgage and the interest rate on the higher returning product. Another common investment people make is in tax shelters. An example of a tax shelter could be a business partnership, usually silent, where a business has a big initial investment in property, plant, and equipment, or maybe they're looking to spend the first few years gaining market share the way that Amazon did instead of taking profits. Those business expenses would be passed through to the partners in the partnership, reducing their tax burden in that year. Eventually, you'd expect a big payout out of it, and in the front end, you save money on taxes. At this point, you might be thinking, I have a life. How could any normal person afford all of this? The answer is by managing their portfolio. Firstly, in our safe zone, we're looking at things that provide liquidity, tax advantages, and protections from loss of what we have. Pension accounts don't do this, so don't put anything from the tax deferred column in this safe zone box. Have you ever heard of a backdoor Roth 401k account? Well, Roth 401ks have income limitations. Many rich people, after a year of investment, pay the tax on the interest in their 401k accounts and move it into a Roth 401k using the back door. In this way, they come up with a tax-free growth account that they wouldn't have otherwise have, creating a new asset class. You don't have to be rich to do this. Since the main return from the top left-hand box is the employer match, get into the practice of skimming off the top of that account and moving the earnings into the bottom right-hand box. There are also contribution limitations on 529 accounts and HSCs, along with the risk associated with the limitations of their use. So think about how much you usually spend on health expenses and whether or not your kid is likely to receive a scholarship or decide not to go to college when you're putting money into these kinds of accounts. Term life coverage can be risky because the premiums can go up over time, and at the end of the term, you lose your contributions. But if you're in a squeeze, make sure you at least have some coverage. Take your savings from your tax deductions and bank them either into protection accounts or to spend on growth. Move savings into tax benefit accounts first, as this is usually your biggest advantage, and then move what's left on a mix between moderate and high growth depending on your risk appetite. Make sure to max out on employee stock options. With stocks, what we're looking for is always an undervalued stock, and employee stock options usually come with a discount. So keep them to the length of their term and then sell them, using them as a funding mechanism instead of a place to accumulate growth. This shift of above the line to below the line moves our paper assets into real wealth. Keep in mind that most passive income sources like dividend stocks are moderate growth if you intend to use these for immediate income, whereas high risk, high return accounts are more likely to drastically change your situation in life. If we pay attention to diversification according to risk and growth as well as tax, we not only look for growth, but we create new asset classes, improving our return on risk. In addition to having more money to play with through managing our portfolio, we also save on income tax in retirement through the growth on the tax-free accounts. For example, if we took an average $80,000 income during our retirement, we would save 11% or almost $9,000 in income tax during our retirement. That's a huge bump to how much you actually have to live on during those restricted income years. A quick reminder to also pay attention to the fees on your account. A small percentage difference when compounded can have an outsized impact on your investment. Futurists also pay attention to trends. When deciding how much you'll need in retirement, pay attention to the way your expenses change across your lifetime. For life insurance, what you'll need will shift across your life as well. The main variables to keep an eye on as you manage for risk and opportunity in your portfolio over time are inflation impact, tax benefits and rate changes, rates of return on risk and investment, withdrawals from accounts and contribution pauses, and changing needs relating to income, net worth, or coverage requirements. It may seem like a lot, but managing your portfolio will become second nature to you. All things have a learning curve. If you find yourself behind the mark on how much you should be saving by your age and stage in life, consider a savings challenge. To generate wealth, you have to live below your means, but keep in mind that this is with the intention of increasing those means later. Check out this video on how to set goals and stick to them.